The information in this podcast is current on the day of recording. It is general advice only and does not take your personal situation into account. It may not be suitable for you. Participants in this podcast may also own the stocks discussed. For a full list of current recommendations and stocks owned by staff, members of Intelligent Investor can visit www.intelligentinvestor.com.au.
Welcome to Stock Take. My name is Gaurav Sodhi. Joining me today is analyst James Greenhouse. Welcome, James.
Hello, Gaurav.
And joining us also is analyst Mickey Mordek. Hi, Mickey.
Thanks, Gaurav.
Wow, we have a three-person team back on deck again, so no more awkward interactions with just two more people.
Yay.
So we're really happy to have you both here. Let's get straight into it. Gents, we've been writing about Webjet recently, and I had a look at the company after JG has had a look at it, and also our small cap analyst Alex had a look at it as well. This is an interesting business. It's a controversial one because we've been wrong about it over the years. We've written several reviews about Webjet, sort of scratching our heads thinking, how does this business model actually work? Because to sum it up, it's a collection of, well, the Australian business anyway, the actual flight business is a collection of times and flights from all different airlines, and it brings it up on the screen. And if you click the flight you want to take from the Webjet site, they'll charge you an additional fee, or you can go over to the actual airline and book it through the airline and pay no additional fee. And so this has always been a source of, ludicrous lunacy for me, really, about why anyone would use the product as anything other than a search tool. But clearly, plenty of people does. Revenue is strong. It's been growing for many, many years. It's generated lots of profits. It's actually been a terrific performing business over a long time, and proved the skeptics wrong. They've now introduced a second business, a business called Webjet, and this is a business that digs into global hotel inventory and then sells that inventory onto other travel agents around the world, and they call that a B2B business. And this business has been growing, again, really rapidly, generates really good margins, very good returns, and management claim they've only just scratched the surface of the potential addressable market, so they're looking for a lot more potential growth. There's a $50 billion market, apparently. They've gone from nowhere to being the global number 2 in this space, and this is the source of a lot of optimism. And if you're going to build an investment case for Webjet, this is the area that is most interesting about it. So we had a look at this business, and specifically on that Webjet area, and I came away relatively unimpressed. Look, I think it's an okay business, and if it works out, it'll work out really, really well. But looking at all the growth coming from Webjet, it's all come from acquisitions. And the business has grown solely because they've poured more capital into it. And for me, there's nothing really special about that. Anyone can grow a business if they're willing to spend money on it. Any competitor could have done what Webjet has done. The fact that they were the first to do it, does that make it better or more interesting? For me, probably not. And thinking deeply about the competitive position, Webjet, well, let's get into this a little bit more. James, I'd like your thoughts on this, actually. I've been a bit skeptical about the Webjet's competitive position. What's your view on it? Would you agree or would you disagree?
Look, to be honest, Gaurav, if I can just jump back a bit, for me, recommending and buying and looking at a company for members is all about getting comfortable. And so for me, I looked at Webjet, and I can get some comfort with the basic flights business, and we sort of, I think Alex made a good point in his article that business is okay and it's used for convenience purposes, and people are happy to pay for that convenience and for the fact they don't need to fill out a whole lot of online forms to get their flights. But I think you're right there, is that I struggled to get to terms with the B2B web bed banking business, the hotel aggregation business, and I still don't understand it. I'm happy to admit that I don't get it. I can see, and as you say, they've been basically buying and consolidating the market there, but it's still a very, very very fragmented market. And it seems that the current managing director that's his history. So he joined the business, joined the flights business, and basically then started building this B2B I'm actually saying web bed banking business.
Web beds.
Yes, web beds.
Yes.
And to me that business is it's still we still don't know how it's going to turn out. And to me, that's the thing. I'm just not comfortable with it. I couldn't get comfortable with it. I don't know where the growth is coming from. It seems to me, as you say, mainly acquisitive growth. And I just thought, I don't really understand this business. It looks okay. The business overall looks okay. I'm not saying it's the worst business in the world. I just couldn't get to grips with it. And for me, that just rules it out.
Sorry, just to clarify, so isn't the idea behind it that if you're looking to book some accommodation, and you're a business, then you go to this website and they have accommodation in lots of different places, basically, and they aggregate that information from lots of different suppliers.
It's a behind the scenes business. It's not like a What If or a Expedia where you actually, as a consumer, go to a hotel website and they're the hotel aggregator. It's basically providing services to travel agents, both online and offline. So it's like the system that those travel agents would use when they're sitting behind the desk asking you, what sort of hotel do you want? It's a B2B business. So it's like that, okay. but it's. I mean, and I don't understand where all the margin comes in that, and why that is such an important thing. I don't see why that can't be disaggregated at some stage. So there's just things about the business that raise questions for me.
The margin was the big question for me. If this was actually a more conventional margin wholesaler, and that's what this business is, it's effectively a wholesaler. They buy, they do buy, but they don't actually pay for bedding from hotels, hotel rooms from hotels, and then they supply that to third parties, and they sell it, and those third parties then sell it to the retail channel. So they're a middleman, and yet the margins are sort of 35% or so, which is extraordinary. In an era where middlemen are being squeezed in every industry, here lies one reporting growing and huge margins. I just found that quite disarming, and without a comprehensive explanation about how those margins are sustainable, I just don't think we can recommend a business like that. Or, there's so many opportunities on the internet. There are so many opportunities on the stock market. There's so many companies to pour your attention into. If you hit a wall with one, I don't think we have to come up with an explanation or an answer for that one straight away. We can sort of put it in the corner and think about it a bit more, or come back to it at another stage when we've had a bit of enlightenment.
And we know we've written 3 articles on Webjet. I know that's been confusing for members, so we do apologise for that. And we know Alex has got it in his fund, or he did when he wrote the article. I assume he probably still does. So that's just the way it is. And in a fund, the position can be managed okay, and he's comfortable with some things that I wasn't. And Alex made some great points about management and things that I think make sense. It's not the worst business in the world. And for people who own it, we're not saying sell it. We just personally, Gaurav and I couldn't get comfortable with some of those aspects, and that's okay.
It's a different burden of proof as well for a newsletter business and a fund.
Indeed.
It reminds me a little bit of the civil case versus a criminal case. A different burden of proof is required. So for us to put a buy on something, what we're saying is it's good enough for almost everyone's portfolio, and we have to think about tens of thousands of people who are building portfolios on the back of advice that we're giving. And it's very different to having a small position in your fund that you're able to manage quietly without upsetting other people's portfolios too much. It's 2 very different things, and I would view those as almost 2 separate decision streams. So the amount of information we need to get comfortable is a little bit different to what a fund might require to get comfortable. Sorry, Mickey, go ahead.
Oh no, I was just going to say, well, when I heard about the business, the only thing I could think of was, so if you're a travel agent and you're trying to book accommodation, then you'd want somebody who's got the most availability of inventory, and you'd also want somebody who's got a global reach. And I suppose from that perspective, it almost makes sense to make acquisitions so that you could get that scale. And then, so on that side, if you can get the scale, then potentially you can attract more travel agents. And then on the other side, if you're selling the inventory to web beds, you want to be with somebody who's got the greatest distribution. So there could be like some sort of scale advantages in that business that could give that some edge over time potentially.
Absolutely, and that's sort of the investment case, isn't it? And if you think that's a good reason for them making acquisitions, then it certainly makes sense that they should get bigger in that space.
It just sounds very easy, Mickey, and there are 4 big competitors in this space. We know that, and it just sounds very simplistic to sort of say, let's just get bigger and that'll make us better, because they're buying these things very cheaply. And it tells, and the fact that they're buying their targets very cheaply tells you that the other 3 big players aren't doing this. And it just makes me a little bit uncomfortable about why, if this is such a great idea, and I agree, the logic sounds compelling, and that's the reason we went back and had a look at it, because the logic does sound compelling, but why are they the only ones doing it? I would almost feel better if there was more competition for these acquisitions and the prices were higher. But they're buying them at sort of 4 or 5 times earnings, and
that was exactly the thing that worried me. The Thomas Cook thing is
right.
when I looked at it a year ago, and I thought the Thomas Cook, it looks weird, and I didn't understand at the time what was wrong. I couldn't understand it, and a year later we find Thomas Cook's gone bankrupt, and they have to write that acquisition off. And I actually went and had a look at, when I was overseas, when Thomas Cook collapsed, and I actually went and had a look at Thomas Cook, and it was pretty clear that business has been in trouble for years now. So it just made me think, well, okay, if Webjet's buying this thing when other people know that Thomas Cook's sort of not doing that well, just suggests to me maybe they haven't done their due diligence properly, and
they're more interested in growth than in sustainable growth.
That's right.
Yeah, and the incentives are really marked as well. I mean, the management team is incentivized just to get big really quick. Mickey, any other points about Webjet?
No, not really.
Yes.
No.
So to summarize, it's a potentially interesting idea, but we just haven't been comfortable with some of the risks. And in a newsletter business, the burden of proof is much higher than I think than in a fund inclusion. So hence the decision to sort of look not to buy it or to cover it ongoingly. We're just going to leave it for a while and we'll keep an eye on it, right, James?
That's exactly right.
So how are you feeling, James? Your toes tapping? There's music. There's movement.
We're about to get passion on.
Yeah, we're going to get it on.
It was a long time ago.
If you're wondering what we're talking about, you can read JG's review on Dominos and all will be explained. Now, JG, speaking of Dominos, they had their Investor Day recently. I think the AGM you mentioned earlier is this week at some stage.
That's right.
Talk us through what you learned about the Investor Day. I believe this was a particularly important one.
Yeah, the Investor Day was quite interesting because the Dominos has been criticised by the investment community, I suppose, for a couple of things. And the first thing that they've been criticised for is, or what people are worried about is probably the best way of putting it, is the store splitting strategy that they've been talking about. And so they explained a lot more about that. And it was just quite interesting to have, and clearly, we always take these with a grain of salt. We don't believe everything management tells us, but they did provide a little bit more colour on how they split their stores and why they're doing it and so on. They call it fortressing, which is a little bit of a gimmicky term, but it does make sense in a way because what they're trying to do is get closer to the customer, and it just means they're effectively trying to put more stores out there. And one of the big things that for me was that with splitting stores, what they tend to do, they get a lot more carry-out customers or takeaway customers, so people who are much closer to the store, they actually will therefore walk and collect their pizza rather than pay a delivery fee. So clearly, if you're closer to the store, you get far more people who come in and collect their pizzas, and that actually is a massive part of the store splitting strategy.
So is this a strategy to actually expand the market and to drive out competitors, or is this a way just to get store numbers to meet a predetermined target?
Well, of course, that is a risk, and they keep upgrading their store guidance and saying, for example, we want to do 1,200 stores in Australia, which currently is 825. And I think I've been saying pretty clearly that the Australian market is mature. But you're absolutely right, Gaurav. I mean, don't forget if you go on your local menu log or Just Eats or whatever, you'll see there are a lot of mum and dad pizza places still out there, and so there's still a lot of them out there. And to be honest, Domino's is going to try and kill them. That is a fact. I mean, this is what happens with big companies is they try and put their competitors out of business. And I had a look at the Domino's US. Domino's US, they sort of talk about that basically and say there's a lot of, they call them mum and pop pizza places out there, and they think that they're subscale and that they're struggling. They're struggling with the rise of the aggregators, and that they'll eventually be put out of business. So that's going to happen in Domino's in Australia as well.
Yeah, I must admit, I always struggled with understanding what's it called again? Fortressing.
Fortressing, yes.
I always struggled with the fortressing concept. I didn't understand how putting more stores in would make franchisees happy, or how that would increase growth in the business. But after reading your review, hearing from management, I get it now. It actually sounds like a reasonably good idea. Are you aware of other franchises that also do a similar thing? It seems to me, just anecdotally, it seems like a classic McDonald's play. Not that they have delivery, but they just the area, the catchment area for something like McDonald's just keeps on shrinking and shrinking and shrinking. Is this happening across the board in the takeaway industry?
I think that's possibly right. I'm not sure. I need to think about that more to provide a comment. But what I think is most interesting about Domino's compared to McDonald's, for example, is that you can't put a McDonald's everywhere because they're large and they tend to require car parking, all that sort of thing. With a Domino's, I mean, if you just think about your local store, it's tiny. They can put that in any local shop fronts. You can wedge it, in your local, what used to be a corner store. You can put them anywhere. And so it's a bit you can saturate the market with stores, and I think that makes a bit of a difference. That actually means that if you want something quick for dinner, you can say, okay, well, pizza's good enough. I'll go around the corner and I can be eating my pizza in 20 minutes. Whereas with McDonald's, unless you're right near a store, you're going to need to drive there. You're going to need to find parking, so it's going to take a lot longer. So I think the Domino's is a little bit different. It's sort of as they say, they're dealing with hungry people. People want their pizza in 10 or 15 minutes. They don't want to wait. So it's sort of they're just playing to their market, really. Their market really wants fast, hot pizza.
We've discussed this before, but pizza is uniquely suited for delivery in a way that burgers and chips are certainly not.
Yes.
And I almost think the competitors are the mom and pop stores more than they are other things on the Uber Eats list.
Yes, that's right. Yeah.
Well, the other thing I noticed was I was just going through the Deliveroo app the other day, and I just saw a Domino's on there. So it's not like they're not actually taking advantage of that avenue as well. But yeah, so it's not as if that's necessarily going to put them out of business or something like that. Like some of the maybe concerns around that have been.
And that's a nice segue into my next point about the aggregators, Mickey, because that's exactly right. They don't. I mean, with going onto the aggregators like Deliveroo and Uber Eats, they will go on those platforms, but you generally don't get discounts. So if I'm looking for a Domino's pizza, I'll look for the codes which give you, the free garlic bread or free drink or whatever as well, because it ends up being a better deal. Whereas you don't really get that on the actual apps. So they make good money out of the aggregation apps, and they also they do all the delivery. So they still have control. Domino's still has control of the customer, and I think if you are, dare I say it, a true Domino's customer, you're probably not going to use the aggregator apps anyway, because you know what you want. You know that there's a Domino's, 2 or 3 or 4 minutes walk away, and you can go and pick up that pizza if you want, or if don't feel like leaving your sofa, you can get it delivered, and it's going to come quickly. Whereas if you're on Uber Eats and you're going to order a chicken parmigiana or something, it's going to take 45 minutes to get to you. So it's quite a different type experience, I think.
I also I question how valuable the Uber Eats or the aggregator channel is for Domino's, because when you line up Domino's on a list with all of its competitors, who thinks, oh, yum, I must have Domino's? I just don't think that's not really the market there.
Yeah.
They're not the food of choice when you're comparing meals. It's the motivation for having Domino's is completely different.
I agree. Yeah.
So it doesn't actually concern me that much. I was very concerned about the aggregators at first, but just talking to JG, listening to the company a little bit, I should disclose that I actually own Domino's. I'm actually pretty comfortable now with the aggregators, and I think it actually might be a chance to knock out a lot of the mom and pop stores. The aggregators, if you think they're hurting Domino's, they must be killing the $20 pizza. Crust, for example, has been, everyone thought it was a great business at first, and it's been really awful, and I think a big reason of that big reason for that is the impact of the aggregators. That's the kind of business that gets targeted and hit from an Uber Eats.
Absolutely.
So, James, what are the risks from here? I mean, the share price has gone up a fair bit. You seem pretty comfortable around strategy, and you've still got the European expansion coming along nicely. Has the opportunity actually improved now that you're more comfortable with Australia, or is the price sort of compensating for that?
The price has gone up a lot. The price is up 30, more than 30% since you recommended it, and that's partly because they had the market hates profit downgrades, and they'd had basically 5 downgrades. The market just focuses on that, whereas what we tend to do is focus on, okay, the market's had 5 profit downgrades now. If they have another one, the market already knows it's coming. So, and that's exactly what I think is exactly what happened. And now the market's now focusing on the European growth opportunity, and Domino's has said, yes, we think that the store rollout profile in France and Germany is actually only really just starting to hit its strides. So there's been some positive news. The market's now looking, rather than focusing on the profit warnings, the market's now looking forward to the actual growth opportunity, and that's what we thought is at some point the growth opportunity would come to the fore, and we think that's going to happen. So yeah, but despite that, I think the business is perhaps better than I thought. I mean, it always takes you a while to even though I've been looking at the Domino's business for more than a year now, it takes you a while to get comfortable with the business, as I said, even with Webjet. And I think that the more I look at the business, the more comfortable I get. And I just think they're now really the partner of choice for Domino's US, and Domino's US in terms of granting territories. They're going to look at Domino's Pizza Enterprises, the Australian company, and say, look, these people know what they're doing. They've done it so well. Domino's in the UK is a bit of not doing so well. So I think they're really the partner of choice for Domino's US.
Yeah, look, I must admit, James has been going on about Domino's for almost a year now when we first started mentioning it, and my reaction has always been, Domino's, no thanks. I haven't really been interested, and there's been, I'm not sure about the other guys in the office, but certainly I've not really been interested very much. And valuation sort of was really attractive when you upgraded, and that's what got it over the line. But having looked at the business in a bit of detail, before I bought it, I was stunned by the quality of the business, and how much cash flow comes out of there is extraordinary. The other thing probably worth shouting out about is the quality of the management is properly impressive. These guys, most of them have owned franchises or have been with the business a long time. You look at how senior executives relocate, and unlike, say, Woolworths with Masters and Wesfarmers with Bunnings UK, those companies didn't put a lot of effort in. They just put a little bit of capital and crossed their fingers and hoped everything would work. And when it didn't, they ran away. I really like that Domino's has picked a territory such as Japan that no one thought that would work. And they sent senior executives who lived in Japan, lived and breathed the product for a long time. And when it wasn't working, they went back and tried to fix it. And they went back and tried to fix it. And after several iterations, it started to work. That shows me that management's actually really high quality, that they're willing to solve problems, not just cross their fingers and hope something works.
And I think that's actually a great point, Gaurav, is that they stick it out and they do the groundwork. And you might think that selling pizza is an easy business, but it's not. It's different in every single market, and Japan is the perfect example. It's a very, very different market. And you need to understand local tastes, and and there's a certain scale you need to get to. And so all these markets are very different, and they need to put in place a lot of groundwork, and it's only and the markets change. So as there's sort of a 300 store market in France is going to be quite different to when it has 500 or 700 stores, and they'll do their marketing differently. They'll have different commissaries which actually do the dough in these markets, and so all these markets change and evolve. And Domino's pizza management in Australia sort of knows that, and they do the groundwork and they stick it out. So I'm pretty happy with the way it's going.
Yeah, and when it scales, it would scale really nicely in Europe once the store numbers get up. So Mickey, get on to it.
I still find it pretty amazing they're selling pizza to Italian people, but there you
actually,
go.
I think that's that's not Domino's Australia, but they are rolling out in Domino's. I think that's the US business, or I'm not sure exactly.
I was shocked to learn that France is one of the biggest fast food consumers in the world.
It's amazing, isn't it?
I think they're McDonald's most profitable territory outside the US. And very big on pizza too.
Yeah, it shows you all your preconceptions about a nation are wrong sometimes. Yeah,
always look at the numbers and test. Yeah, that's right. Now, Mickey, you wrote up ARB about a week ago now, wasn't it? It's been a little while.
Yep.
More than a week ago. Anyway, you wrote it up, and you're getting close to upgrading that stock. This is a business we've had a long association with. We've been really successful with it for a long time. It's always been on the wish list of most of the analysts here, but we haven't upgraded it in a long time, years in fact.
Yeah.
How close are we?
Yeah, well, it's beginning to look fairly attractive now. I suppose we're at a point now with new car sales having had a pretty terrible last 12, 18 months. I suppose it's overflowing from, probably the hangover from that correction in the housing market that we had. And that seems to be coming through now in kind of the growth results. So this half, management said basically not to expect any growth, which is very unusual for a company that's grown earnings for a couple of decades pretty consistently. And
So they're attributing that to the car sales and a lag in that, are they?
yeah, so there's a couple of things. So there's the car sales, and then there's also the low Australian dollar. So the low Australian dollar helps with their exports, and that's great. But also now they've just shifted a lot of manufacturing over to Thailand. And if you've been traveling in Thailand lately, you'd know that the Thai baht's appreciated quite a lot. So the cost of their workforce there is putting pressure on margins. So they've actually had sales growth, which is still pretty impressive. Particularly in this market, but yeah, it's just that the margins are obviously getting hurt a bit. So hopefully, what will happen is that it maybe gets a little bit worse before it gets better. People might start to kind of extrapolate that trend, and then hopefully we get an opportunity to take a closer look at it.
On multiples, Mickey, it doesn't look particularly cheap for this kind of business. It is a bit more capital intensive than say a Dominos, and the multiple is quite high still. Is that a cyclical earnings situation, or is that because people haven't really people are still optimistic about it?
Yeah, I mean it's on 24 times forward earnings, so it's not cheap. And I mean if we were to upgrade it, we wouldn't be expecting a 20+% return or anything like that. So I think it's kind of one of those stocks where you can kind of let the quality. And the fact that the balance sheet as well is so clean, this company has lots of different growth options that they can kind of explore. And there's also other things. So the fact that they own $150 million worth of property as well, which is throughout their store network as well. So that tends to make it look a little bit cheaper than that 24 times multiple would be. But yeah, I mean, it is a business that's growing quite quickly overseas. One of the things I guess I kind of struggled with originally when looking at ARB was just trying to figure out why this was actually a good business, because when you look at it for the first time, you kind of go, this is just a manufacturer of car accessories, and they tend not to be very good businesses. But what you find over time is just that these guys have built, all these parts, and they've developed this amazing brand over that period. And so now that brand name, if you speak to four-wheel drive enthusiasts or you speak to anybody about four-wheel drive parts, it's kind of synonymous with quality and with, having the best parts. And I guess the other thing about it is that when you buy a new $80,000 vehicle or whatnot, then you're happy not to kind of skimp on the bull bar that you put on the front or the air lockers or the suspension or something like that. So yeah, just that share of mind, I guess, is kind of the thing that that they've kind of got going for them, and you can see them kind of starting to export that to other markets now.
You mentioned that overseas. So, I mean, how is that overseas going? Because obviously, when you take that to a market like the US, they don't know the brand. So, do you get a feel for how that's going in the USA?
Yeah. So far, it appears that they're taking a slow and steady approach. So, I think the way that management has always kind of approached these things is they would rather go slower than they need to. So they kind of tend to go through, find a stockist, for example, get their stuff into a store, and then they'll kind of develop stockists over time. So instead of just having like a little section for ARB, over time they'll start to build out their product suite within an actual store. And what you see is over time, these stockists actually just become purely ARB dealers because they can offer the full product suite. And so that's kind of their expansion strategy. They said that they're growing. It's not just the US, it's also Asia. They're quite big in Thailand. It's the Middle East as well. So they seem to have an approach that works. I think management also goes about it in the right way. That they're not trying to grow too quickly. They're not overextending themselves. They're not taking on debt.
That's extraordinary, actually. The growth that the business has had, when you look at the balance sheet, it's never taken on debt. It's all kind of come from internally generated cash flow.
Yeah. And they do have to put in, every time they want to grow, they have to buy more inventory. So it can be quite a capital intensive business. But there's other things that they can do as well that it's hard to kind of compete with them. So, for example, they've just got the scale now where they can invest a lot of money in developing the next generation of products, but also, just ordering cars before they're actually on the market to actually equip them so that as soon as that car hits the market, they've got a whole product line ready to go. Whereas like a smaller competitor, it would be quite hard to do that. So,
and in Australia, they've grown by actually launching their own retail stores as well, correct?
Yeah.
Is that unique to Australia, the retail model? Are they going to, do you think at some stage become a retailer overseas too?
I think that's definitely possible. I don't think they'd do that at this stage. But I think it's definitely a possibility in the future.
And finally, Mickey, can you talk to us a little bit about cyclicality? In Australia, where it's quite mature, I imagine this is a more cyclical business, but should the sales cycle for cars, which globally, by the way, has been quite low, should that worry us too much? When you look at the international opportunity.
Yeah. So there's a few things here. So I guess on the cyclicality side, it's definitely a cyclical business. So the amount of new car sales that we get, broadly speaking, is obviously going to determine to some extent the amount of equipment that you get put onto the new four-wheel drives. But there is also a big market for just replacing these parts on used vehicles as well. And it's hard to determine actually what percentage of business that is, but I'd say it's a fair amount. So, so it's not as cyclical as you might actually think. The other thing I would say about ARB is because they don't take on debt or anything like that, the cycle could actually leave them in a better position competitively over the next 10 to 20 years because, if they've got smaller competitors that can't ride that out, they can be aggressive, they can expand, they can make acquisitions, and they can do things in a downturn that hopefully should set them up better over the long term. So I think the cycle is probably the friend of this business over the long term. And then I guess just the other thing on that point would be that so we've seen big run up in forward drives as a percentage of actual vehicle sales. So whether I can see reasons why that might actually be here to stay because people are finding that this is actually gives them access to a lifestyle that you can't get without a forward drive. So people now pack up their families, they're going out camping for the weekend, and so having access to that lifestyle as well, and just more room, especially when people start to have kids and things like that. So
I don't like SUVs at all, but I was listening to a car executive, I think it was from BMW, I'm going to say, but I'm not 100% sure. But he was saying that he agreed. He was saying that this move to SUVs, he reckons, is absolutely permanent. He says the efficiency, the packaging efficiency of the sedan body shape is just inherently inefficient, and that to get more space into the boot and also to free up interior space, the SUV body style is just more efficient and it makes more sense. So
for sure,
BMW has just moved all the way towards. They're basically an SUV business. I think more than 50% of sales are SUVs now. I think that's true for most car makers.
Yeah, I think what you're seeing is just that middle size of the market is what's making way. So the very small size, for zipping around the city or around the suburbs, that's fine. And then the four-wheel drives, obviously, that's doing well. But it's kind of as you mentioned, the mid-size sedan that's kind of making way. So.
It's a great shame. All right, Mickey, you've got your eyes on that. So you'll just quickly run us through the what's the upgrade price on that one?
$17 at the moment. I think off the top of my head. No.
I think that's right. I think it is.
Yeah, it's
$17.
somewhere around there. But so we'd probably give that a little bit more space before we upgraded. We're not kind of in any massive rush, but hopefully it's a business, so we get an opportunity to buy at some point. Yeah,
Mickey's all over it. All right, we better leave it there, gentlemen, and thank you very much for joining me. JG, thanks for your time.
Thanks, Gaurav.
Mickey, thanks for joining me.
Thanks, Gaurav.
For everyone else, thank you for listening.